Hi everybody, good afternoon from me. My name is Sofia. I'm an associate professor in VUZF University.
And I'm the head of the pension and insurance department within the VUZF Lab, and also the head of the finance scientific department. We are starting the second session of the conference. I think the first session was very interesting, and I hope everyone to have something in mind on the next discussions. The second session is designed first with a keynote speech. I'm honored to have this one. After that, we'll have the panel discussion. The panel discussion, we have representatives from Ministry of Finance, from European associations and bodies, and also from the academia. After the panel, we'll ask the questions which are raised from the audience and have some conclusions. And after the questions, we have another research papers who will be represented from our colleagues. So we start with a keynote speech. It is pre-recorded for the sake of security, and I hope to enjoy this video.
Hello, good afternoon to everybody. My task is to deliver speech about the basic PEPP. The speech is based on the paper I have written for the collective scientific forum for the conference. The report is analyzing the formulated basic PEPP and then searching answer whether through the proposed design could be reached the preset goals. The goals are to offer good quality product to savers and to increase the savings in personal retirement products. The core objective, as stated by the VUZF, is to be a simple, cost-efficient and transparent product with sufficient long-term real investment return. As we all know, the basic PEPP is the mandatory offer that has to be delivered by the providers. The PEPP regulation specifies that each PEPP provider can have up to 6 investment options, one of which needs to be the basic PEPP. There are two main features that distinguishes the basic PEPP from the other PEPPs. The first one is the cost cap of 1%. It is very important, and we'll discuss later. The second one is that the basic PEPP is the default investment option. So, when analyzing the framework for the basic PEPP, still there is concerns whether the basic PEPP will be attractive to savers from one hand, and from the other hand, whether it will be financially viable to providers. The European authorities expect from the basic PEPP to be safe, transparent, and cost-efficient. So let's analyze these 3 areas. Safety. We have for the PEPP capital protection. This is one of the standardized features for the PEPP. The capital protection can have the form of a guarantee or the form of risk mitigation technique. So the guarantee means guarantee for the accumulated contributions after tax. And the applied risk mitigation techniques has to be consistent with the objective. So I stress on this word, the objective, to allow the saver to recoup the capital. Here comes the first problem. How the saver will assess the effectiveness of risk mitigation technique. In the current framework, we don't have clear benchmark. How the saver could follow that the applied risk mitigation technique is in line and reasonably expectable to reach the PEPP investment objectives. So, again, for the guarantee, when we look the informational documents, the KIT and the BC, benefit statement, we can see that the guarantee is not well presented as an advantage. So it is a problem when talking and creating the so-called equal level playing field for the providers. Here we can have the so-called regulatory arbitrage. Something very important for the safety is whether we have national guarantee scheme for the product. It's positive that in the KIT document, we have section what happens if the provider is unable to pay out, where shall have description on whether the related loss is covered by investor compensation or guarantee scheme. But here is hidden one problem. The saver has to compare PEPs with different guarantee regimes. For example, in Bulgaria, we have in fact 4 markets considering the potential providers: life insurance, pension institutions, asset management companies, and banks. So national guarantee schemes we have for life insurances and for banks deposit. But for voluntary pension insurance and for mutual funds, we don't have national guarantee scheme. So the saver has to compare products not only with different levels of guarantee provided from different types of financial institutions, but he or she has to take into account whether some part or the whole amount of the saving is under protection from the national guarantee scheme. Concerning safety, the other 3 bullets are important elements. Advice, we'll discuss this later for the costs. The provider's prudential rules, which in fact are different for the 4 types of providers. And here also we can have a problem which consists of stricter prudential rules for some providers compared to others. For example, it is said that life insurance companies have stricter prudential rules compared to asset management companies. Stricter rules means increase in the cost of the capital, so increase in the costs. And also supervising, which is very important, and EIOPA and national competitive authorities are saying more about this. And when talking to safety, about safety, we have to take in mind that we have many trade-offs. For example, trade-off between safety to costs, risk to performance, cost to performance. Let's discuss about the second area, transparency. The long-term nature of the product requires transparency in order to convince the potential saver to buy it. We need sufficient amount of information. So we are talking about quality, quantity, and the information has to be delivered in a proper way. So we go to simple disclosures, but these simple disclosures depend on the features of the product. And finally, we're going to the simple product. Is it possible to have a simple product when we're talking about long-term retirement product, which is delivered by 4 different providers? Whether this product will be easy to understand. All this depends on the business mechanics behind the product, the business processes with these providers. So we're coming to the problem number 4. Different types of providers, insurers, pension institutions, asset management companies, and banks. And for the saver, it will be difficult to compare between basic PEPs from these 4 types of providers. So it is good that we have 2 informational documents, the kit and the benefit statement. The kit, the role of the kit is to reveal the nature, risk, costs, potential gains, and potential losses of the PEP as a product and the particular PEP that is offered to the saver. And the kit has to enable the saver to compare different PEPs. I believe that crucial indicator for the transparency is the level of comparativeness between PEPs and PEP with alternative products. That's not, we have not only competition between PEPs, but competition PEP with alternative products. So the saver has to think on 4 levels, 4 layers. First, PEPs to alternative products. Second, PEPs from different types of providers. Third level, PEPs from providers of one type. And 4th level, PEPs from one provider. We can have up to 6 options from one provider. Again, for the transparency, it is positive that the European authorities conducted consumer testing of both informational documents, but something very important is mentioned during this consumer testing, that the disclosure of risk information triggers doubts and fears. We have to take this into consideration, and in both documents, the tax regime of saving in PEP is not well presented. In my opinion, this is very important because the tax motivation, the tax stimulus is very important on the beginning when the saver decides to start the saving. And we have different taxation of the saving for these 4 groups of providers. Also, for example, the current situation in Bulgaria is 2 products have tax advantages, life insurances and voluntary pension insurance, and bank deposits and mutual funds don't have tax reliefs. And when talking for the transparency and all these problems, we can draw a conclusion that the marketing and agents' effectiveness to convince the client will be key for the saver's decision in a situation where the client is in difficult position to decide alone. So it is very important, the distribution and the power of distribution. Let's discuss the third area, cost efficiency. The PEPP regulation requires EIOPA to draft regulatory technical standards that specify the types and costs which should not exceed 1% of the accumulated capital, the so-called cost cap for the basic PEPP. So EIOPA proposes to introduce an all-inclusive approach encompassing all costs and fees for the basic PEPP, and to set up an exhausting list with costs exempted for the sake of a level playing field of different PEPP providers, which means to exclude the cost of the capital guarantee. But this all-inclusive approach could lead, and particularly the proposal to include the cost of advice within the cap is likely to lead to the PEPP be commercially unviable. This is strong warning of one of the industry associations, IFAMA. No matter that EIOPA is searching compromise for the cost cap, the possibility for amortization, the one-off costs that cannot be covered in the year of occurrence. So here we have a hidden problem. As we say, the cost of capital guarantee is excluded from the cost cap. Also, not included in the cost cap is the cost of biometric risks, just because biometric risks are considered not costs, but features of the product. And when analyzing the cost efficiency, we can see that there is a combination of cost cap, standardized features, and also discretionary options. And I think this is the right policy, this combination, because it leads to some kind of balance between highly standardized product and at the same time leaving room for innovation and healthy competition. Very important for the cost efficiency is the possibility for fully digital disclosure and distribution regime, including automated advice without any human intervention. Online distribution is considered as a tool for reduction of the costs of the service. So we can see that the digital offer is encouraged by the current framework of the PEPP. Another very important element of cost-efficient PEPP is the easing of the will performance threshold. So in the current framework, we don't have particular targets with exact numbers. Of course, we expect from the PEPP to outperform inflation and to lead for real increase of the saving, but not setting such threshold creates opportunity the PEPP to be viable from the provider's point of view. And let's not forget that the client can choose one of the other 5 options, not the basic PEPP. And if the saver is searching higher yields, he or she can opt for alternative investment options. This issue is a trade-off, again, between robust capital protection, higher costs, and innovative alternative investment options. What can we set for conclusion? in my opinion, no matter of the risks of the PEPP initiative of the European Commission, it has good chances to succeed. PEPP framework at the moment is creating an opportunity to meet the targets, to give the savers more choices, to provide competitive product, to achieve a relatively high level of protection of consumers, and to support the mobility of the citizens. But still, there are too many trade-offs and risk to lose focus. And we need further efforts and measures from the 5 stakeholders: European authorities, national competent authorities, regulators, providers, and distributors. And all these efforts has to lead to gain trust among savers, which are the 6th element, the most important stakeholder, the savers, and to deliver viable product on the market. Thank you for your attention, and I'm open for questions after the panel discussion.
Thank you. If there are any questions, I'll be happy to answer after the panel. Let's start with the panel. Within the panel, we have Христина Пендичева, Martin Ramharter, Evelina Miltenova, Falco Valkenburg, Francesco Briganti, and experts from the Financial Supervision Commission of Bulgaria. The panel is designed as the pan-European personal pension product through retirement savings product. We hope here to learn more for the product itself. Our panelists are representatives of regulators, Pension Security Association, and independent expert organizations. Maybe we all expect to know more about the future steps of the relevant state authorities, the opinion of one of the group of potential providers, the pension institutions, and the analysis of the proposed PEPP framework from the Actuarial Association of Europe and the Cross-Border Benefit Alliance in Europe. My first question is to Ms. Evelina Miltenova. Evelina is chair of the Bulgarian Association of Supplementary Pension Security Companies. Ms. Miltenova has established herself professionally in the field of financial sector and investments, having gained in-depth knowledge and many years of experience in banking career and asset management business, with focus on the capital markets. And maybe my first question is, what is the attitude of the Bulgarian Association of Supplementary Pension Security Companies towards the proposed PEPP framework? Thank you.
Yeah. Good afternoon on my side. I hope we hear each other. If you don't, just let me know. Thank you very much for inviting us to this special conference. Actually, we were attending the first conference about pan-European pension product back in 2018. Of course, being the leader in the pension market locally in Bulgaria, it is our great interest also to participate and also to deliver our expertise and knowledge. Thank you very much to VUZF for the whole, of course, conference, for organizing the conference. Back to your question, in principle, the Bulgarian Association of the Pension Funds is comprised of 9 members, which pension companies which manage close to 9 billion euros already. It's a significant amount for the Bulgarian, for the local market. As the only provider of this, for example, a peer product of a PEPP, which is the volunteer pension product in Bulgaria. Basically, our pension companies, which are the members of the association, actually come up with a very balanced, principally positive, of course, attitude, which is basically based on the fact that this is a new opportunity. The Pan-European pension products is a new way, as you mentioned, and not only you but also the colleagues in the first panel elaborated very in detail and very comprehensively about what the PEPP is, what are the positive sides. On our side, the main advantages, what we like a lot, of course, is that of course it's about the reliability, about the safety, and of course the increased and enhanced competitive environment, because it's always good to have a competitive environment, which now with the PEPP product itself actually goes beyond the borders and becomes also cross-border. Of course, this is extremely positive for us. Actually, the new regulation of PEPP is more or less close to our local legislation, with, of course, significant differences, I have to say. But at the same time, the main let's say, I will not call it problems, but the main challenges would be how the current regulation, European regulation, will be implemented by our national competent authorities, and also implemented by our regulator. Whether the product in Bulgaria, for example, will definitely cover not only the accumulation phase, because we always have to compare apples with apples, but also the decumulation phase, because we are now paying pensions in the volunteer pension funds, which is a very demanding, regulatory-based and very responsible business, linked also to very high and stringent regulatory requirements. So we are really, when we start to compare, it's not easy to compare because all the parameters are not identical. We pay pensions even now in the volunteer pension funds, but will the Pan-European pension fund somehow obligate the future providers to come up and provide lifetime pensions? Because this is in the essence. Otherwise, it will remain rather a good product, pan-European. The people will save long-term, no problem. They will save, they will invest, they will use it all over Europe. But at the end of the day, who will pay their pension at the end of their working life? This is something which actually is one of our concerns. And also the approval by the national authorities, and it has to be, of course, adapted. It's just the beginning. It's just the beginning. The European regulation is not fully concluded entirely. Also, on a second note, it's very important also to stress again our opinion about the fee cap, which is practically and realistically not feasible in our view. This is something which is extremely challenging. Having done this business for more than 20 years, the pension companies in Bulgaria, for example, not only in Bulgaria, know very well what is the level of the costs, even with the investment. And when we include also, it's all-inclusive 1%, and when we include also the investment advice, even if it's digital, because actually in the last presentations we saw the opportunity, of course, everything is or the industry is modernizing. It is getting closer to the modern reality with digitalization. But still, the investment advice is costly. You should have really competent people to do this, which is also highly costly. It's a very clear message, and I will liked a lot your conclusion that it's a great project. It's a great project. It has to be taken into. It has to be further finalized in time, and we are certain that down the road in the next year, probably a compromise should be achieved somewhere in order to provide and ensure successful kickoff of this product, which is, of course, which will be attractive for the providers, profitable for them, and also feasible to do it. Because a single provider without existing economies of scale, because the economies of scale is the only way to survive. If for a provider, in case the provider wants to offer this product. The economies of scale of the big institutions actually offering many investment products like insurance, asset management, banking even. This will be the only way to cover this fee cap. Overall, the other aspect that worries us a lot is about the biometric risks, because no one is at the moment taking into account fully the biometric risks. If this is a pan-European pension product, and because we know that we have also actuaries now on the call and the colleagues, this is a very complicated calculation, and the national biometric tables are different everywhere. What will happen with this product when it has to be implemented in each and every country? What kind of biometric tables these providers will be actually prescribed by the regulator to use? This is another thing. Or maybe we should go into the direction of a pan-European biometric table, or we don't know. But this is a big question mark. The question mark is who, at the end of the working life of the saver, will structure and pay his lifetime pension. This is my first statement at the moment. Thank you, Stanislav.
Thank you, Evelina. Very detailed talk, and you raised also some questions. Maybe we can go with Falco Valkenburg. Falco is an old friend of VUZF University. He participated in the previous conference. Falco is an independent consulting actuary. He is immediate past chairperson of the Actuarial Association of Europe and closely involved with pension developments in Europe. He is also vice chairperson of the Occupational Pension Stakeholder Group of the European Insurance and Occupational Pensions Authority. So, Falco, in the PEPP, it is envisaged capital protection, and it can be two forms, guarantee and risk mitigation techniques. Would you explain more about the capital guarantee and how the saver will understand the difference between both of them?
Thank you very much, Stanislav, and thank you for inviting me to this conference once again. That is really appreciated. And first, before I start to answer your question, I have just had an observation that PEPP has been established by the power of 3 women, in fact. And one of those is on the call, Kristina Padicheva. She has been key, I think, when Bulgaria was was holding the presidency of Europe. And Sandra Hack, we heard her this morning already at IOPA. And then in the parliament, we had Sofia in 't Veld. So I think this is the development of bringing together three powerful ladies and, well, with a great achievement. I hope, at least, because the Actuarial Association of Europe is in general very supportive of this initiative. But there are some obstacles to take, and they have been pointed at, and it is also in your question about capital protection and risk mitigation, and will the saver understand the difference between both of them? Well, in the original proposal, there was only a guarantee option in the basic PEPP. And we as actuarial profession were not too happy with that, because a capital guarantee, that sounds nice, but on a very long term, on a 30 or 40 year horizon, it does not deliver a lot. It is recouping your money that you paid in, minus the costs, and then it does not take account of inflation, of purchasing power. And that is difficult to understand for a consumer, but in the end, the capital guarantee does not have a very high value on such a long term. It could be different on a shorter term, by the way. So we are happy that there is now the possibility of applying a risk mitigation technique, and that is what we welcome. Of course, it is also rather mathematical, and that is what we actuaries like. So when I look at a guarantee, that is not only in terms of what I just described, perhaps not very valuable, but also it is perhaps not aligned with your desires for the decumulation phase. A capital guarantee could be interesting if you would like to have a lump sum, if you would like to have cash at reaching your retirement age. But if you want to buy an annuity, want to buy a pension, then this guarantee does not work for that, because you would like to have an amount of capital that is in line with the purchase, the annuity purchase that you are aiming to do. And then cash will be, in general, very risky even. So I do think that it is generally very difficult for consumers to understand what a risk mitigation technique is. And a guarantee is much easier to understand, although with what I've said already, perhaps they even don't understand fully what a guarantee will imply. But the key information document, in my view, is very clear in telling the consumer what you can expect, well, whether you can expect a guarantee or not. That is already on the first page. Is there a guarantee, yes or no? And further, it provides the consumer what amount can be expected at retirement under different scenarios. The scenarios like poor performance, medium performance, and very well performance. And also for different ages. And I would hope, and I think that that gives at least a good feel of what they can expect. They will see what the amount is that they can expect under several scenarios for their situation. And further, the conditions for the risk mitigation are clearly set. So it is thoroughly described what the requirements for the risk mitigation are. Yeah, so I think also allowing the possibility for risk mitigation supports the aim of the European Commission to have a broad range of possible providers of the PEPP. Because if there would only be a guarantee for the basic PEPP, I think it will only be for insurers to offer this product, or at least an asset manager or any other provider needs to link with an insurer for this guarantee part of the basic PEPP. So I think it helps, it contributes to the desire of the European Commission to have a broad range of possible providers. Well, let's stop there for a moment.
Okay, thank you, Falco. You mentioned three powerful ladies, and also in the chat we add Nathalie Berger, who was within the European Commission and responsible for pensions at that moment. And I think also four powerful ladies and one father, maybe Gabriel Bernardino, because I remember 2 years ago when he was speaking at our conference, he said that PEPP is something very close to his heart. So I think he also made substantial efforts to happen this framework. Using, you mentioned Christina Pendicheva, she is part of our panel. Christina is a senior expert in the Department of Regulations of Financial Markets in the Ministry of Finance of Bulgaria, and she has extensive experience in participating in the groups considering pensions, capital markets. I use the occasion to ask Christina what has to be changed in the legislation of Bulgaria after the final approval of the technical standards for the PEPP.
Thank you very much, Stanislav. Do you hear me well?
Very well.
So first of all, as this is my first intervention for today, even though I'm following the conference since the beginning, allow me to thank you, Stanislav, and also the whole team of the university for the organization of this second high-level conference, which really get us all distinguished representatives of the relevant stakeholders, both at EU and national level, which have worked hard on the PEPP regulation. Allow me also to thank Bernard and Falco for the very kind words for the Bulgarian presidency work on the PEPP regulation. This was really a team effort from the Ministry of Finance and Financial Supervision Commission side. And it's also, like Yorick mentioned in the chat, Ms. Nathalie Berger from the European Commission made a really serious effort to push the adoption of this regulation, and also Mr. Bernardino that you mentioned. I would like also to thank our Austrian presidency colleague, Martin is also here on the call, which have pursued our efforts in the difficult negotiations with the European Parliament. So to come back to your question, Stanislav, a lot of challenges have been mentioned in the previous panel and in this one. PEPP is really an innovative regulation which gathers for different types of providers. So it is really challenging the implementation that is going to happen starting from next year. So the level 2 measures will be adopted probably till the end of this year. So we all hope that till the end of next year we can implement the PEPP regulation. So what we should do from our side is to ensure that the regulation can be applied at national level. So there are some things that have been left in the regulation to national authorities, like, for example, the conditions for the accumulation phase and also for the decumulation phase. The decumulation phase have been mentioned several times this morning. This is really something which is not harmonized for the moment. So, for example, the age of retirement or the form of outpayments will be something which have to be decided at national level. So we at the Ministry of Finance, together with our colleagues from the Financial Supervision Commission, will start work next year on the legislative amendments that we need to introduce. Also in respect of the pension companies in Bulgaria, the issue of the IORPS, we all know that it was a very difficult issue in the Council and in the negotiations also after that with the Parliament. Now, currently, IORPS that are also allowed to provide personal pension products can provide PEPP. So our pension companies would be allowed to provide PEPP, but we need to make some amendments in the national legislation in order to ensure how this would happen in practice. So I think this is from my side for the moment. Of course, I would be happy to answer any questions, and I would just like to mention that PEPP is really a new regulation, so there will be PEPP 2 and PEPP 3, and there are a lot of things that could be improved. I think that the fee cap, which has not been included in the Council approach, is really a challenging issue because, as you also mentioned, Stanislav, in your presentation, it would be very difficult to compare the different PEPPs. So the saver would need advice, and the advice is costly.
Yes, thank you very much, Christina. Taking from your speech, we can address to Martin Ramharter, another representative of Ministry of Finance of Austria. Martin is a senior legal and policy advisor in the Austrian Ministry of Finance. He is a member of the expert group for banking payments and insurance and represents Austria in Council working groups. So, Martin, maybe the same question, because we're interested about the experience of Austria. What in fact you are planning to change in the legislation in order to be compliant with the PEPP framework?
Yeah, thank you very much, Stanislav, for inviting me to this very interesting and fruitful conference. Good afternoon also from my side. It's the situation is pretty much the same as Christina already explained. We will start our project in Austria next year, and it will be particularly important to decide on the accumulation phase and on the decumulation phase. And we will also have to make a decision regarding the IORPS issue. For the moment, IORPS would not be allowed to offer a PEPP because they cannot offer a third pillar products for the moment, but this is still an open issue. But maybe let me briefly explain or give you some insights about the status quo in Austria, because this probably makes it a bit more easy to understand why the PEPP regulation might really be a step forward when it comes to the provision of third pillar pension products. Our national PPP at the moment is called the Prämienbegünstigte Zukunftsvorsorge, which you can translate into English freely by saying it's a retirement product with a tax bonus. And so the basic features are that there is a 10-year minimum savings period. There is a guarantee on the premiums plus the bonuses you receive from the state. And this guarantee is combined with minimum equity investments of 15% if you're under 50 years, and of 5% if your age is over 50 years. And you only get the full tax advantages if you have outpayments in the form of lifelong annuities. And as you can imagine, this combination between a guarantee and a minimum equity investments makes this product quite expensive, especially since the financial crisis. And this is why the number of PEP contracts, of PPP contracts in Austria has decreased from around 1.5 million to around 1 million. So there is a really need for reform. And so the PEP could kind of be to make a reform of the third pillar pension system in Austria. Thank you.
Thank you, Martin. Here in our panel, we have Francesco Briganti. Francesco is Secretary General of Cross-Border Benefit Alliance Europe. Francesco has been a member of the Occupational Pension Stakeholder Group of the European Insurance and Occupational Pensions Authority. And the Cross-Border Benefit Alliance Europe is a Brussels-based advocacy organization promoting cross-border and pan-European employee benefits provisions. So, Francesco, you have also a presentation after the panel, but before the presentation, can I ask you, because you have great experience with international providers, and how do you evaluate the potential interest in international players to develop PEP?
First of all, I would like to thank you, Stanislav, and all the organizers of this event, which is great. And I think it was very interesting also to listen to the previous discussions and the presentations. So, yeah, to answer your question, well, for sure, there is a big interest, or at least for the moment, I can say that there is, as far as I know, also talking to my members and to many other stakeholders, there is for sure a big curiosity about this new product. That's clear. Then, of course, it was said already, and you also said it during your presentation, Stanislav, but many others, there are still some unsolved questions that should be answered. So there is curiosity. Maybe there is a potential appetite. I would say there is a potential appetite. But for sure, some issues should be addressed before we are sure that this product will really take off. That's I think that's clear. Anyway, for in the international providers' point of view, you can imagine that for them it's a great opportunity to sell PEPs throughout Europe, and so basically to enter the markets of other member states, big international providers, but we can also imagine about big employers. And even for that, I think then we will come back to this this issue. We have to take into consideration that the PEP is the real first pan-European pension product. And so maybe even the employers could be interested in offering this pension to their employees. I think Hans van Merten made a presentation on that. There are still some legal questions, but I mean, that's a fact. I would say that just to come back to the question, for sure, it would be a pity if then, because of the points that were made before, especially the problem of the mandatory advice for the basic PEP under this fee cap. Well, this would be really a pity if then those international providers would decide that the PEP would not worth it for them. So I really hope that a solution will be found In this, maybe I would tend to disagree with Hans van Merten on the fact that the fee cap of 1% is fine and for every situation. But I think he was referring more to an occupational scenario of the PEPP. To be honest, even talking to some insurance companies, they were much more concerned about the fee cap on the mandatory advice, even more than on the guarantees. And you know that the guarantees are anyway excluded from the fee cap. So, I mean, in principle, we could say that insurers should be happy about that, but they are still concerned about the fee cap on the mandatory advice, which is quite a news, I would say, for them, for us. And so, I mean, if it is really true, then I would say that this is the big, great point that would potentially make the difference, whether or not the PEPP will take off. And then, of course, we have another big issue, which is, I mean, there are many, but another big, to me at least, it is the taxation treatment. And the taxation treatment is could be a huge obstacle because even though the PEPP is in fact a pan-European pension product, we know that with the taxation for the moment, the European Union cannot do basically anything or almost anything. And here, my fear is that if some member states will decide for a reason or another to not, let's say, welcome the PEPP in their territories, they could very easily discriminate the PEPPs and basically to not offering the same tax advantages offered to their own national products. And yes, of course, we can still imagine that the PEPP would be very interesting for mobile people, but we can also imagine that in the European Union, the great majority of its citizens still live in their own countries. And then, as a consequence, if the taxation treatment for their national products will be more favorable compared to the PEPPs, in those markets, the PEPPs will never develop. Then, as a lawyer, I could tell that maybe, and I think it was mentioned, if I'm not wrong, by Martin Lepala before, tax treatment might be also an issue that could be treated by the European Court of Justice, because anyway, a discrimination based on nationality, whatever it is the topic, including tax treatment, is something that is not in principle acceptable by the European treaties. So, but of course, we can imagine that a case in the Court of Justice might take time, a long time before. So, I mean, I hope that these two obstacles will be overcome. I'm saying that I can confirm, and I stop here, that there is a huge potential interest from international providers to offer and develop apps in Europe. Thank you.
Thank you, Francesco. You focused the attention on several problematic areas. I'll use the occasion to address one of them, the tax issue. And my questions to the two representatives of the Ministry of Finance, Bulgaria and Austria, maybe Christina and Martin. In fact, what is the relevant approach about the tax regime for saving in PEPP? In fact, this is a product which could be delivered by 4 groups of providers: life insurance, pension institutions, asset management companies, and banks. What do you think?
If I may start, yes, Stanislav, and then give the floor to Martin. Actually, yes, the providers are different. So we have 2 concepts in the PEPP regulation, which I would like to mention. First of all, I agree with the colleague, Mr. Iosifov from the Financial Supervision Commission, who said that a PEPP is a pension product and is one product. And the favorite phrase of Nathalie Berger that we have mentioned, a PEPP is a PEPP. So no matter of the provider, this is one pension product. So the Commission recommendation that Matti has mentioned this morning is in this direction that member states are encouraged to provide the same benefits, tax benefits that they provide to their national pension products, which are similar. Of course, this is a matter of national discretion. So there is this recommendation of the European Commission, but also, as Mr. Van Merten has mentioned, in the Netherlands, for example, this would not be the case. So there would be no preferential treatment for the moment of PEPP. So this is really a challenging issue, especially in the cross-border situation. So PEPP is one product, but from the other hand, it is true that there are different providers. So we apply the PEPP regulation, but we also apply for the matters not regulated by the regulation, the relevant sectorial legislation. So yes, we would have to think about next year how we can organize possible tax incentives. And this is really a complex issue. We had discussions also in council with tax experts. And unfortunately, there was no uniform decision back then. So this is really something that I suppose that also in other member states is an issue.
Martin?
Yes, thank you. The treatment of the PEPP itself will be decided within a package for a major reform of the Austrian tax system due within the next few years. So it's too early to tell about the details. But in general, when we have a look at our current PPP, this is a product which can be offered especially by insurance companies and asset managers. And there is the same tax treatment for this product no matter who is the provider. So it's kind of an EEE system because there is a tax bonus. So it's at the moment 4.25% of the in payments you make up to an amount of 125 euros. And our experience is that this kind of tax incentive really kind of works well because it's an incentive that makes people buy such a product. And then capital gains during the accumulation phase are exempted from capital gains tax, and which is also a major preferential treatment. There is no income tax on the outpayments if you take out lifelong annuities. So this is a system which is neutral to the type of provider. Currently, and we will see how we will develop this system in connection with the PEPP.
Maybe back to Evelina. Something which is very interesting for Bulgaria. In fact, we have saving in voluntary retirement products for 26 years. And a year ago, I was trying to compare both products, the saving in voluntary pension funds in Bulgaria and the PEPP. And this analysis shows that around maybe 80% of the features of the PEPP we have in the voluntary pension saving in Bulgaria. I was joking with my colleagues that maybe the European authorities copied the features in the PEPP. So, Evelina, what do you think? Where do you see the place of the PEPP in the Bulgarian pension system, particularly in the third pillar?
Thank you very much for the question. Actually, it's a very good way to enrich the product the product mix offered by especially by the third pillar part of the pension industry, which is based on capital-based pension products. We hope that it will be a good complementary product to the existing private pension system, especially in the volunteer pension with the volunteer pension funds here. This will be a very interesting actually market opportunity, as far as I also heard the colleague who spoke before me. Actually, it's very challenging and very attractive for the big players to enter market, but at the same to enter new markets. But at the same time, it is not very, in our view, from the point of view of our pension companies, it's not very easily to fully compare. As you said, 80%, but this is yes and no, because it's in our view it's too early really to compare, because we still, as I said earlier, we don't have any certainty that actually these the PEPP products will be how they will be structured in the legislation, and whether they will be able to pay also life pensions, which is the difference with the volunteer pensions at the moment, which pay, as you said, rightly said, pay pensions, life pensions for 26 years. For us, it's a little bit too early. I hope that we will have another event when everything is more clear. It will take time as well. From the point of view of the pension industry as a whole, it's a very specific business as a whole in Bulgaria. And when I see some international players accessing our markets, also they should be very, very well aware that the capacity, and not only for Bulgarian market, of course, everywhere for all providers, is that the capacity of the providers should be also increased, not only in terms of investment advice, in terms of product investment, in terms of investment management, but as well as in terms of really complying with the current parameters and requirements which the local products currently provide in different markets. In the case of Bulgaria, for example, it's very challenging in our view how that each and every day there is a market revaluation of the pension shares, let's say, in the fund. So everyone should have access to his or her portfolio, or to at least to know knowing the number of units, what is the current level of the revaluation. It's quite challenging in terms of providing capacity, people, in terms of increased costs. This is something which has to be taken into account. But we, as I said, we definitely welcome. It's a complementary product, and will provide definitely very good opportunity for the long-term pension, for the long-term pension savers, whom, of course, we have also to teach and to educate further. This is our ambition everywhere in Europe, I believe, because especially in our region, we need higher financial literacy. Thank you.
Thank you, Evelina. I will use the occasion from your speech. You mentioned several times the accumulation phase and the payments. I want to ask Fauco, because in the two informational documents, the kit and the benefit statement, it has to be projected what the saver could expect to receive, and also in the draft documents of EIOPA, there in details is revealed the stochastic modeling that has to be used. But what is your opinion, Falco? How the projections will be comparable between the different providers, the PEPPs data provided by different types of providers?
Thank you for this question. I think IOPA has been pretty prescriptive, and that is a good thing in this case, with prescribing a standard set of assumptions that has to be used. And it has been set out in great detail by IOPA, and that should certainly help to compare products of different providers, or even different products from the same provider. But you can have a difference in asset mix and still be in the same risk indicator. And then it will be difficult, and if not impossible, to compare the cost loadings of the two products. And what could be a suggestion for further exploration, I would say, is to require, in addition to the scenarios, but that is even more work, and well, that will also come at a certain cost, of course. But if we would require a projection based on a fixed expected return, independent of the asset mix that is chosen, and you could think of, well, say 4% or something like that, a fixed interest rate, just for comparison reasons and just to see how all those different products perform on a cost basis, basically, because the input is then the same on the expected return side, and then you will see what the different cost levels will be, how that would work out in the projections. The problem then still is that if you have a different asset category, a more riskier one with a higher expected return, that is also perhaps more costly, so there can be an offset there, and that will be difficult for consumers to look through, I would think. But the positive thing of such a fixed interest rate usage would be that at least a reasonably well-informed advisor could help a consumer. But then we are back to the advice topic again, which also should be contained in the cost cap, at least in the basic PEPP.
Yes, thank you, Falco. I was interesting again for Francesco Briganti. Again, question about the potential demand, because I think that the demand is very crucial. And what is your opinion, Francesco? How the personal pension product relates to cross-border pensions? In fact, if the PEPP will really work in the next future, don't you think that some employers, especially multinational companies, of course, will be tempted to offer PEPPs to their employees?
Yes, thank you for the question. I think it's a very interesting question. First of all, we have to say that how does the PEPP relates to cross-border pensions? Well, first, I would say that the PEPP is probably the first real cross-border pension, at least for 3 reasons. The first is that it's completely regulated, or almost completely, a great part regulated by the European Union. And it's a second EU regime, which is also, I think it was very, very smart, because having a second EU regime means that, first of all, you are a European regime, but secondly, you are voluntary. So basically, you don't affect the local national pensions. And that's good somehow, because then providers or maybe employers or users can make a choice. The second reason is that it is, in fact, a legal tool by which it is regulated. It's a regulation, and regulation, by definition, does not leave very much discretion to member states, so there is not room of maneuver as opposed to a directive. And the third reason is that so-called cross-border activities, and we are talking about cross-border activities and not cross-border pensions, in the case of the second pillar pension, so the so-called IORPS, pension funds. Well, in the case of cross-border activities of IORPS, we do have national pensions, basically. IOPS are national entities, in great part regulated by their national law, which can carry on and carry out cross-border activities from their own member state. So basically, it's a real cross-border, the first real cross-border pension. Then, the second part is a little bit more tricky. Employers would be tempted to offer PEPs. I mentioned it a little bit before. In my opinion, yes. In my opinion, they could be tempted because, like I said, as it is a real cross-border product, if you think about, like you mentioned, Stanislav, multinational corporations, which employ workers in several EU member states, but for them, the priority is to have centralized administration, portability. Imagine the portability. The portability is not possible, for example, with the, it is possible, but it's very complicated with the cross-border activities of IORPS. Here you have a fully portable product. So even the infra-corporate transfers, you can imagine some executives of a company transferred from a national branch to another one in Europe, they can take their money with them, which is, for a company, would be perfect. At the same time, and that's an interesting debate that was already raised a little bit by Hans Van Metten. This product is, in principle, it is a third pillar product. Then we can discuss to what extent companies, employers could make use of them, of PEPs, as opposed to the traditional IOPS. Here, maybe the thing is that it would be, how to say, maybe a little bit a pity that employers offering good occupational pensions in their countries will decide to abandon their national occupational pensions because the PEP is more interesting. So basically, I would hope that there will be no conflict between a second pillar product or a tool. Many people don't like to call the second pillar pensions products, but pools, as opposed to a third pillar. At the same time, the PEP, again, under the condition that it will function well, it will be unfairly much more competitive compared to the cross-border activities of IOPS. And so basically, maybe something should be done with the second pillar pensions and to make them more easier for cross-border activities, or even, why not, to do something else. Otherwise, at the end, probably the PEPs will be more appealing, and basically a very interesting pan-European product in the third pillar will prevail on the existing second pillar pension. So that's something that we would not like. My organization promotes cross-border arrangements, so we like a lot the PEP, and we do promote the PEP. At the same time, we would like that something will be done also for the second pillar pensions, because otherwise it will be unavoidable that one day some companies will say, you know what, the PEP is more appealing, thank you very much, we will shift from our second pillar to PEPs.
Thank you, Francesco. I'm encouraging the audience to ask questions to the panelists. You can use the chat. Waiting for questions. I have one to the representatives of the Financial Supervision Commission, because during the panel it was mentioned about the distribution, and I was wondering whether the Financial Supervision Commission is planning special regulations for the PEP distributors. I mean, not financial institutions, the providers, but the distributors. Do we have from the Financial Supervision Commission? Maybe not.
Hello.
So,
hello. Can you hear me?
Yes, Josif. Yes.
It's Josif Josifov from the Bulgarian Financial Supervision Commission. Because the regulation is more or less a legislative activity, I just want to once more underline that we can participate actively in the dialogue, but unfortunately we do not have the legislative initiative to initiate special regulation for the moment for the PEPP distributors. So that is from me. Thank you.
Okay, thank you. And before just to check for questions from the chat. Yeah, Christina. Yeah, can you intervene?
Yes, Stanislav, thank you. I just wanted to remind that according to the PEPP regulation, PEPP distributors could be the investment firms or the insurance advisors under the IDD directive.
Yes, thank you. And if we don't have questions to the panelists, we can move on to the reports. The first one is from Professor Pier Paolo Marano from the University Cattolica del Sacro Cuore Milano. And Professor Marano is a professor of insurance law and regulation. Also, he holds a PhD in banking law and regulation from the University of Siena. And he is a scholar in residence at the University of Connecticut, School of Law, Insurance Law Center, an affiliate faculty at the Department of Insurance at the University of Malta, and honorary fellow at the University of Hong Kong, Asian Institute of International Financial Law. So, Professor Marano. Just use the microphone. Yes.
Can you hear me now?
Perfect, yeah.
Okay, so good afternoon to everyone. It's a great pleasure to be connected, even though virtually, with all of you. And so the topic of my speech is related to the design and distribution of a pan-European personal pension product. So the regulation on PEPP aims to harmonize a set of core features for the PEPP, as mentioned just a few minutes before, I think, by Francesco Briganti. And the core features for the PEPP concern key elements such as distribution, the minimum content of contracts, investment policy, provider switching or cross-border provisions, and portability. So the harmonization of those core features should improve the level playing field for personal pension providers at large and help boost the completion of the capital market union and integration of the internal market for personal pensions. So having in mind this, and regarding the design and distribution, the PEPP regulation identifies the rules that apply to all the entities allowed to be registered as a PEPP provider and or to act as distributors of PEPP. The harmonization across the member states is achieved through the introduction of rules on product governance, advice, information conditions, including standardized pre-contractual information, the Pep Kit. In addition, the general principles for distribution activities mirror those for the distribution of insurance and financial products. That is, distributors must always act honestly, fairly, and professionally in accordance with the best interests of their customers. So, these core features of the PEPP should be a self-standing regulation. They replace the corresponding sectoral rules applying to each of the entities who will be manufacturing and distributing PEPP. So the European Union, therefore, has introduced a legal framework of so-called second regime to offer an additional and complementary personal pension product for people who do not currently have access to adequate provisions in some member states, or to broaden the consumer choice or offer solutions to mobile citizens in the other member states. So although these harmonized rules are self-standing, they are inevitably grafted into sectoral regulations. And I can predict that the interplay between the sectoral rules and the core features for the PEPP will be one of the reasons why law professors will be interested in PEPPs. So I will now introduce a first set of questions related to this interplay between the core and harmonized rules for PEPP related to the distribution and design of PEPP, compared to the sectoral rules regulating the same profiles. Of course, this is just the first set of questions, and without claiming to consider this list as exhaustive of the issues that might emerge. So, the outline of the rule Article 25 of the PEPP regulation on POG mirror the outline of the corresponding rules in the IDD and MiFID II. However, these directives are complemented by delegated acts which provide further details on the process of product governance. These details are missing under PEPP regulation, nor the Commission has been delegated to adopt these rules. In addition, in early October, EIOPA issued a document which aims at providing more clarity for insurers, manufacturers, and distributors on the supervisory approach to POG requirement. Thus, no mention is done to the to PEPP. Thus, the harmonization of the rules should be supported by harmonization of supervisory practices. What can we predict for the POG on PEPP? And lacking specific detailed rules on PEPP, we can predict the product governance process will be modeled on that followed under the IDD or MiFID II, which are similar but not identical to each other. Thus, the harmonization of the POG on PEPP could diverge, as the detailed rules are those from the IDD or MiFID II. Second issue. So the IDD, if we take into account this more detailed legal framework developed under the IDD and MiFID II, we understand something. First of all, the IDD provided that insurance intermediaries can be considered co-manufacturer, where an overall analysis of their activity shows that they have a decision-making role in designing and developing an insurance product for the market. Can we exclude that a person authorized to distribute PEPP assumes a decision-making role also in their manufacturing. And in this case, what rules do we apply? In addition, an active role can be played by entities other than PEPP distributors. Recital number 24 of the PEPP regulation states that a PEPP contract might also be concluded by the representative of a group of PEPP savers, such as an independent savers association, acting on behalf of that group. If this entity does not qualify as a co-manufacturer, what happens if the entity is able to negotiate a specific PEPP product on behalf of the group? The delegated regulation on insurance products, the act adopted by the Commission to complement the IDD, provides that the personalization of and adaptation of existing insurance products in the context of insurance distribution activities for individual customers, as well as the design of tailor-made contracts at the request of a single customer, shall not be considered manufacturing. This rule applies the principle of proportionality. Can we recall the same principle in case of PEPP? And then can we exclude from the POG the tailor-made PEPP tailored around the demand and needs of a single individual customer? In this case, I made reference to someone who is acting on behalf of the group. In any case, the manufacture of the basic PEPP, which is, the basic PEPP is the PEPP we have to offer, and maybe with other options. So, but the manufacturing of the basic PEPP recalls the principle of proportionality. The minimum contents of the basic PEPP are detailed under the PEPP regulation. Thus, the main issue of the process involving the basic PEPP seems to be the selection of the distribution channel, as well as the monitoring of the distribution, rather than the stress testing and the scenario analysis. So, my understanding is that the PEPP regulation on POG, product governance, must be interpreted in accordance to the principle of proportionality, and in case of the basic PEPP, we need to be focused on the distribution rather than the manufacturing of the products, especially in the case where the PEPP provider intends to distribute the PEPP across the European Union. So in this case, it's much more important to understand if the provider has been able to select a distribution network in different countries to distribute the same PEPP. And this is the most important part of the POG with reference to the basic PEPP. But concerning the distribution, the set of rules on product governance does not mention either the negative target market or the gray area. Unlike the provisions of the product oversight governance for financial products. So the question is, do we need to identify a negative target market when this identification better clarifies the target market? This is the case, for instance, under the MiFID II, where we are requested, and and according to the ESMA guidelines, we have also allowed to distribute outside the positive target market, also in the negative target market or in the gray area, which is the area in between the negative and the positive. Maybe we can do the same under the IDD, because the IDD was modeled like the current PEPP regulation, so without starting about the negative target market. However, the recitals to the Delegated Act opens to the distribution to outside the negative target market. However, what about PEPP? So, PEPP providers may offer PEPP with an option ensuring the coverage of biometric risks. That is, risks linked to that disability and or longevity. In that case, the coverage shall be granted only by cooperating with insurance undertakings that can cover those risks according to the sectoral law applicable to these coverages. So, the insurance undertakings shall be fully liable for the coverage of a biometric risk. The question is, thus offering a PEPP together with the option of a biometric risk, set up a cross-selling practice? PEPP falls outside the scope of the class number 6 of life insurance. Thus, thus an insurance product is packaged together with a product, PEPP, which is other than insurance. So, this is the case of a cross-selling. PEPP regulation, however, does not provide rules on cross-selling. We should apply the rules on cross-selling provided under the IDD, which makes a distinction depending on the ancillary nature or not ancillary nature of the insurance product to the other product. So, we believe that the main product is the PEPP and the insurance product is ancillary to the PEPP. The distinction between in identifying which is the ancillary product is not an academic issue, but is relevant also in practice. Why? Because we apply different regimes, time practices rather than bundling practices, depending on the ancillary nature of the insurance product compared to the other product. Another issue when it comes to distribution, so the inducements play a relevant role for distributors. And the PEPP regulation does not introduce and harmonize the regulation on inducements. Thus, the corresponding rules on the IDD and the MiFID II will apply. However, these rules are based on different principles, as the inducements are allowed if they increase the quality of the service provided to the customer under the MiFID II, while they are allowed if they are not detrimental to customers under the IDD. Concerning the PEPP, the costs and fees for the basic PEPP shall not exceed 1% of the accumulated capital per year. If the remuneration for PEPP distributors is included in this cap, the basic PEPP is not attractive to them. If the accumulated capital is equal to, for instance, 1,000 euros per year, the costs and fees cannot exceed 10 euros. And the remuneration for distributors is part of this 10 euros, maybe 2, 3, 4 euros. In addition, PEPP can be distributed only with advice. So the provision of advice increases the liability of distributors. Thus, distributors will be careful to evaluate the costs, benefits of such a commitment. Moreover, insurers should be careful in manufacturing and distributing these products. If these products are within the portfolio of the insurer, its distribution network could be deemed under the obligation to consider these products, at least the basic PEPP, in the equivalence assessment when offering insurance products falling within the class 6 of life insurance. So you understand that these are issues arising from a legal point of view. And I would say now, going to the conclusion, that this is quite, how can I say, normal to hear this kind of issues from a law professor. So if you ask a law professor to evaluate new legislation, his analysis is likely to show that what looks like a horse is actually a camel. However, if the analysis provided is good, it helps lawmakers, judges, industry, and supervisors to level the humps by returning the image of the horse. So, in my opinion, we need more Europe, and therefore I'm in favor of a more harmonized legal framework. And I hope my analysis can help in achieving the goals behind the introduction of PEPP regulation, which I agree, rather than incentivizing the rejection of such goals. So thank you for your attention.
Thank you, Pier Paolo, for your profound analysis. I saw a question from the chat. I want to ask, the fee cap was inserted to ensure value for money. Are there other ways that objective could be secured besides having a fee cap? Perhaps for PEPP too? Who will volunteer to answer?
No, okay. I understand the political, value behind this cap of 1% of the accumulated capital per year. However, I mentioned it, and someone before me mentioned it too, that PEPP can be an opportunity for in some countries, PEPP is the only available option for a private pension system. In other countries, PEPP has to fight with other options, or can be manufactured as a niche product for mobile citizens. So if the distributors have the option to offer several products, so distributors will act in accordance to their remuneration. I understand a cap of 1%, but a cap of 1% is not related to the remuneration of the distributor. The cap of 1% is related to all the costs and fees related to the PEPP. So, which means that the percentage of remuneration is below the 1%. So, if you have to ask someone, you have to provide an advice. So, from a legal point of view, your liability will be assessed in a stricter way by the courts, for instance, because you are providing advice. And in addition to this obligation to provide advice, you get peanuts from your advice. I'm not sure that the distribution will enjoy to distribute this kind of products. This is the I think we need a trade-off between, the need to avoid an exaggerated distribution cost to the, you know, the nature of, you know, the choices of distributors. And in addition, as I mentioned, if an insurer or if an insurer includes a PEPP in the portfolio, when the distribution network has to sell this product, they have to compare this product due to the assessment of equivalence to the other products. So if I have in my portfolio a class 6 insurance products, and of course, and the insurer asks me, okay, you have also this product, you know, what I have to do? I have to distribute class 6 insurance product where I can get maybe 5%, or there's a basic PEPP where I can get €2. But in addition, why we have to ask distributor to refuse to get money? So I think that this can be also an incentive to propose other options rather than basic PEPP. Also, if we propose other PEPPs, because if we do not have the same PEPP for other PEPPs, I'm pretty sure that for marketing, you know, the marketing will be, you know, incentivized to better present these options as the best choice for the customers. Maybe it's not the truth, but it depends. I cannot say a PEPP with a guarantee is the best option for the customer. It depends on the asset allocation of the customer. If this is my only pension product, I don't have, or my first regime is more or less nothing, and I don't have a second regime, I understand the guarantee is very, very important. However, if I have a quite generous first regime, pension regime, then I have a second pillar regime because of my company and so on, they provide an additional, and then this can be the third pillar. And maybe I want to get, you know, more return on investment from this PEPP because I'm more protected in terms of the guarantee. So I'm not sure that there's a 1% would be a real incentive to the distribution of PEPP.
Yes, thank you, Pierpaolo. Maybe to this question, if someone from the other panelists want to intervene. No? Okay. Can we proceed with the report from Francesco Briganti, the PEPP in the wider context of the EU initiatives on pan-European and cross-border pensions? Francesco?
Yes, thank you. I'm trying to upload my presentation. I think I can't, maybe if you can help me.
Yes, we will try to help you.
Thank
Just
you.
a moment.
Yes, thank you.
Yes, this is a presentation.
Very good. Thank you very much. So, well, my speech will be about the PEPP in the wider context of the European initiatives on pan-European and cross-border pensions. So I will try to make a little bit an history of the attempts of the European Union to create a cross-border and pan-European pensions. Could you please switch to the next slide? So the first is, the very first point is why the European Union has been trying for years to promote those pensions. Next slide, please. Sorry for that. So basically, we have 5 reasons. The first, which is, I would say, the easier to imagine, is basically the mobility of workers in the EU. Then we will treat them more specifically. Then the second would be the simplification of the management, especially for the corporate pensions. So basically for the pensions created by companies for their employees. The third is to support the financial industry. It has been said quite a lot today. The fourth is the try to enlarge the coverage of those pensions, because we know that in many countries, almost in all countries of the EU, they are not mandatory. And the fifth is the promotion of competition. It's fine. Thank you for switching to the other slide. So let's see a little bit the reasons more in particular. So the mobility of workers. So next slide, please. Mobility of workers. Well, this was an issue from the European Union even from the 50s, because when we created, let's say, the European communities in the 50s, well, the very first problem of the founders of the European communities was to the mobility of migrant workers. Of course, if you create a big space of freedoms, including the mobility of workers, how to deal with the social rights of those migrant workers. At that time, they were called migrant workers. And so the European communities at that time, already in the 50s, created the coordination of the national social security systems, according to which you can move from one country to another, and your social rights are always recognized in the new country of destination. And for example, when we talk about pensions, you can still accrue your pension in the new country of destination. When you come back to your country of origin, those periods abroad are recognized as periods in which you have contributed. So basically, you will get your final pension. Of course, we are talking about the public social security systems. At that time, in the 50s, in the 60s, we didn't have private pensions. Then, from the 90s, the European Union started to think about how also to promote mobility of workers with regards to the protection of private pensions. And we know probably that we had many discussions, many of you know that, about, for example, the very famous Portability Directive. The Portability Directive for pension funds. There was a big, long discussion, especially in the beginning of the 2000, between 2000 and 2010. And we were not able to get a Portability Directive for the funded pensions, basically the private pensions. And by the way, we still do not have a Portability Directive, by the way. So then you know that the IOP directive, at least to promote those cross-border activities, somehow also implying that workers moving within the same pension fund would have had a kind of better treatment if, of course, the fund was the same. And then the PEPP regulation, which instead clearly provides for portability. Okay, so that's the part of the portability. Then the other slide, other reason why the European Union try to promote cross-border and pan-European pensions, this is clearly referred to the IORP, so basically to the occupational pension funds, which are offered usually by companies. And here the idea was to say, well, if I am a big employer and I do have many employees in several countries, why should I have as many pension funds as all the countries where I do operate? I am a big employer, but I have to create today, still, I have to create a pension fund for the country in Bulgaria, a pension fund for my employees in Germany, and so on and so on. But basically, I am the same employer because I am the same multinational. So the idea was to say, let's create these pan-European cross-border pensions for companies in order to favor economies of scale. Of course, it's clear. Centralization of management administration, it is very important for big companies. And then, of course, to have the possibility to cover the mobile workers in case of infra-corporate transfers. Next slide, please. Other reason why the European Union tried, that was later, I would say a little bit later, but the cross-border pensions was, sorry, it's the slide, it's the slide before, the number 3. No, sorry, this one, thank you. To boost the financial industry. Well, the idea to create, to have a big market of the financial services is an idea which comes from the very past. It was not really related to the pensions at the beginning, but of course, when you create a common market, you want also to have a big market of financial services under the European freedoms of mobility of services and capitals. So already, if we go back to the end of the 80s and beginning of 90s, we can read several green white papers from the European Commission's communications about Europeization and the need to Europeize, sorry, this is a verb which does not exist, of the financial services. Then we shift a little bit to the Solvency Directive to a kind of at least a level playing field between insurance companies, banks, to allow them to have cross-border activities. And then we know the IOP directive. And then at the end, we have the Capital Markets Union, of which the PEPP is one of the outcomes. Okay, so this is about financial industry. Next slide, the other reason why the European Union tried to promote pan-European and cross-border pensions, attempts to enlarge the coverage of private pensions. Why? It's very easy. We know all that because of demographic challenges and because of the huge, strong reforms of the first pillar public pensions, in order to control our public debts, to converge with the European economic governance and so on, we know that the first pillar is not adequate enough anymore. So attempts to enlarge the coverage of private pensions, which became a new goal. Again, we have several documents come back from the 90s, the beginning of 2000s, how to try to enlarge the coverage of private pensions. Like I said before, in many countries, private pensions are not mandatory. There are some good exceptions. I think of the Netherlands, I think of some Scandinavian countries, but in the great majority of our countries, private pensions, being them occupational or private, are not mandatory. Then Pension Funds Directive, and the PEPP has the declared goal of extending the offering factor of individual private pensions for those countries where occupational pensions, that we do call second pillar pensions in Brussels, are not developed. Okay, so the goal is here to enlarge the coverage of private pensions. The last step, so the next slide, please, is the promotion of competition between pension providers. When we go back to the first directive on of cross-border activity of pension funds, to be honest, this was not necessarily the very first goal to create competition, because the very first idea of having cross-border activities of pension funds for companies, basically for employers, was really because of the economies of scale and the reasons that I mentioned before. But then some things happened. First of all, we have to say that anyway, the European competition law had several case law, so problems or anyway discussions between the national occupational pensions, especially when they were mandatory in some countries and managed by only one provider in a kind of monopoly. So case law. And then we have to say that with this IOP directive, it was something that was not foreseen, I'm sure, from the European Union at that time. Instead of one single company that created its pension fund in several European countries, well, more and more multi-employer and IOPS platforms, basically they are open pension funds, so occupational but open to companies, were developed. And so what does it mean? It means that some companies now can enroll into a pension fund which is working on a cross-border level, but it's not the pension fund created by the company, but it's just a platform, a financial platform created by someone else, basically by financial institutions. So here we have a competition also between different IOPS working on a cross-border level and which are multi-employer. And instead, the PEPP again, we come back to the PEPP. Well, the PEPP, the initiative to to favor competition between national and foreign pension providers is instead a declared goal. So here it's clear that the idea again to create pan-European and cross-border pensions is also in order to favor competition for the PEPP. Again, it is clear, in order to make, let's say, the market more interesting and to cover more users. So please, next slide. Well, let's go a little bit, let's come back a little bit to the cross-border pensions for the part concerning instead the second pillar. So the workplace pensions created by companies. Please go ahead. Unfortunately, the cross-border activities of the occupational pensions, which are provided by the IOP directives, did not work very well for the moment. First of all, already during the negotiations, it was very interesting to follow the negotiations at that time. We are at the beginning of the 90s and the beginning of 2000s. There was a lot of disagreement between the stakeholders on how to promote those cross-border activities. Several political parties had different opinion in the European Parliament, or having or not cross-border activities of pension funds. And member states, especially the member states that had more developed financial industry, ironically, I think of the UK, was the country which at that time wanted to have more cross-border pensions, because they thought that that would be a big opportunity for them to develop also their financial industry in Europe. The countries instead which were less developed in in occupational pensions, and so funded pensions, I think of the South European countries, but also the continental Europe, were much more reluctant to have cross-border pensions. Well, at the end of the story, the final outcomes of this legislative compromise on the IOP directive was poor. And it was so poor and so complicated for the cross-border pensions that basically many companies were frustrated, because they would have liked, when I say companies, I'm referring to the employers, they would have liked to create their corporate cross-border pensions. But because of this very disappointing and complicated legal framework, they did renounce. Please, could you go ahead? Basically, the main problems of cross-border pensions in the field of second pillar, so occupational pensions, first of all, the compliance with the social labor law of the different countries where they do employ people, confusion, especially at the beginning. Now that's a little bit solved, between the Prudential law that is under the competence of the home state and the labor law instead, which is under the competence of the host state. Well, taxation is still an issue, and you can see here that it is still an issue. The notification procedures to get the authorizations from these pension funds to operate in another country, fully funded requirements. So those pension funds should, at that time at least, should have been all the time fully funded. The IOP 2 directive changed a little bit this, but not really much. Disputes between national authorities, very often, for example, the procedures were very long, the many requirements were very heavy, and that is the lack of the possibility to make transfer between existing pension funds. At that time, it was like this with IOP 1. The new directive allows the cross-border transfers between pension funds, but you will see that anyway, it is still very difficult. In one word, I would say that because of the national protectionism, the cross-border activities of pension funds for corporates did never really take off. Could you please go ahead? Thank you. I'll give you very, very shortly an overview on how a cross-border activity with the IOP directive would work today. So you see that you have one pension fund, say in a state A, could be Belgium, okay? And then we have all those countries where basically the provider should create a pension scheme complying with every single social labor law of all the country where it operates. And this is something, of course, would be very difficult, because in such a case, in some countries, for example, there is still almost an obligation to offer defined benefit pensions. In other countries, you can offer defined contribution pensions. In some countries, you have a typology of governance which requires the participation of both the employers and the unions in the management of the scheme. In other countries, you don't have this requirement. And even for the information requirements, yes, we have the IOP, but the IOP directive also gives minimum requirements. But then the member states can add some additional information requirements in the social labor law. And so for all these reasons, basically you see a fragmented picture, and that's the reason why the cross-border activities from the IOP directive didn't really take off. Please, again, could you go ahead? Well, today, the data are quite clear about the corporate cross-border activities. Officially, according to the last data of IOPA, we have only 83 registered IOPs and of cross-border activities, but active only 73. The news, for many probably, not for all, is that half of those cross-border activities, of these 73 activities, are between UK and Ireland. So basically they were pre-existent to the creation of the IOP directive. So you can see that basically after the first IOP directive was from 2003, now it's 2020, so after 17 years, we have only officially 73 active cross-border activities of pension funds. Yes, there were some improvements, especially in the technology, IT solutions that maybe made the cross-border activities a little bit easier. And then, like I said before, some financial institutions in particular created these multi-employer cross-border platforms and tried to offer and are offering cross-border solutions for companies. But a single company will have a big, especially also a big demand and need of personnel and human resources and cost to create its own cross-border pension fund. Please go ahead. Thank you. IOP 2. The IOP 2, unfortunately, so the new IOP directive should have addressed a little bit all those problems, but didn't really did so. Because basically the situation seems to be quite unchanged. I would even say that since for some aspects, it's even worse than before. First of all, the main normative framework, so the graphic that I showed you before, it basically is the same from the IOP 1. So the structure is the same for the cross-border. Yes, of course, there is the possibility now with the IOP 2 to make cross-border transfers between pension schemes. But then in some member states, the way how they did implement the directive is making it even more, basically impossible. So there is this possibility, but in some countries, it's not possible. Even in some other countries, the way how they are implementing the new directive, even for the pre-existing cross-border provisions, well, now they are implementing the new directive in a way that the cross-border activity is even more difficult than before. Of course, I don't want to mention countries or specific situations, but believe me that it's like this. And then the frustration of all this story is that when you talk to big employers, well, the appetite for cross-border occupational pensions in principle remain very high, but they all tell you, we would like to have cross-border pensions for our companies, but not under this EU regulatory framework. It is too complicated. And again, the IOP 2 did not really solve the problem. Please, next slide. Is it possible to change? Thank you very much. Now, let's compare, and let's come back to the PEPP. Let's compare a little bit the PEPP with the previous explanation of the cross-border activities of IOPs. Well, first of all, it should be stated clearly, personal pension products are less politically sensible than occupational pensions. In occupational pensions, there are many actors who intervene, not only employers, but there are also unions, there are associations, stakeholders. Of course, it's a big business, but also it's very politically sensible. So to touch, a very commercial product like a PEPP or a third pillar pension, of course, is much less sensible than a second pillar pension. So that's the first reason, probably because the PEPP is easier for a cross-border. The second, finally, the PEPP is a fully portable product. So it's of course, it has this added value that even the occupational pensions don't have when they do make cross-border activities. There is no portability. The third is that, like I said it before, the PEPP is under a regulation, so member states has for sure much less room of maneuver, as opposed to a directive. And like I said before, even with the IOP2 directive, because it is directive, the countries are implementing it in different ways because they have a margin of interpretation. And because they have a margin of interpretation, they are making difficult to cross-border, still making difficult cross-border activities. Now, let's wait for maybe some reaction from the European Commission, which should at least send some infringement procedures or explanation to the member states on how they are implementing this IOP2 directive. But the fact is that the regulation is much clearer and less possibility to states to change. Of course, the last 2 points, we discussed about that a lot. We have still some issues also with the PEPP. The taxation is still a problem, and we still something that could hamper the development of PEPPs and cross-border activities. And the fee caps, we said before, well, I think that Professor Marano said it quite clearly, and I think it was very realistic on how he said, it's not even unfortunately necessary the interest of the user, but here it's the interest of the distributor and of the company. So if it could be the best of the products, but if I am not motivated to sell this product because I don't get enough, basically, I will not sell it. And we have to be realistic. So, I mean, this is a big challenge. Anyway, we discussed, I think, a lot about the existing challenge between of the PEPPs, but we also are making clear that PEPPs are for sure much more appealing as cross-border as opposed to the IOPS for the moment. Please, next slide. I'm going to the end. I'm almost finished. So, because of the legal framework of the cross-border occupational pension is very different, and unfortunately, the IOPS, so basically the second pillar for companies, are not really taking off. Like I said before, also myself during the roundtable, well, if the PEPP will work well, some employers could one day decide to offer PEPPs instead of still keeping offering occupational pensions. And that's something that maybe we do not want that. I mean, we do not want that there is a kind of war, a competition between second pillar and third pillar. It was not the purpose. It was not the purpose. But maybe it could happen. It could happen. So now we have two options here. Either the PEPP could, of course, answer three options, I would say. First is that the IOP directive will really be improved in order to make cross-border activities of occupational pension funds easier. Maybe we can wait for the next directive, I don't know. Or the PEPP, it was mentioned before today, could be really and legally clearly sold or offered, in our case, by employers to their employees. And the third option, it's a little bit a provocation on which I'm working a little bit. It's the idea maybe to create a corresponding pan-European occupational product corresponding to the PEPP. So to have an occupational version of a pan-European occupational product. We have the PEPP, personal pension product, and we could maybe create a pan-European occupational pension product. And in such a case, at least, the two products would work, one for companies, the other for individual, but maybe we do not have this competition between second and third pillar, right? So not a competition between personal pension products and occupational products. Please, I'm going to the end, the last two slides. So if we imagine this pan-European occupational pension, that I call it PEOP, now PEPP, personal, or PEOP, occupational, well, if it could really behave as a PEPP, because it would be a new pension regime, a second regime, voluntary and alternative to the existing national occupational pensions. That's an interesting point, because the IOP directive is also a problem for many states, because once the directive is approved, all the pension funds have to comply with this. Of course, if they are in the scope of the directive, should comply with the new requirements coming from Brussels. If we create something which is an alternative second regime, the existing national pension funds should not have burden all the time to comply with the new directive coming from Brussels. At the same time, would be good because probably we could find a way to overcome the compliance, which is now required from the IOP directive, with the different national social law legislation, which is something that I know that there is a big debate, especially between lawyers. It's something that is, we can touch it or not. Well, to be honest, this idea of complying with national social and labor law, what was the outcome of those negotiations to get approved the IOP directive? It was a political compromise. It was not something that was written in the treaties of the European Union. So something maybe can be done, considering also the fact that more and more member states are converging their national systems, because more and more countries are offering giving the possibility to offer defined contribution, even those which in the past were completely against defined contribution, because maybe more and more countries are allowing the lump sums and not only annuities, which was in some countries was impossible. I mean, there are there's a lot of convergence because of the stress of the pension systems. And so now we cannot really say that social and labor law will completely be destroyed if we have a pan-European product working under the same conditions in the different member states. Last slide, please. Conclusions. Well, first, for several reasons, we saw that the European Union tried to promote pan-European and cross-border pensions. The idea to promote cross-border pensions for companies, so for employers, was started several years before the PEPP initiative. We could even maybe think that the PEPP initiative was now put here on the table because probably the European Union got the acknowledgement that probably as the cross-border activities of pension funds for companies did not really take off. Then they decided to shift to the personal pension. Say, okay, companies, we cannot, let's do something for personal pensions. For sure, there is still appetite for cross-border pensions, not only for the personal ones, but also for the occupational ones, like I said before. Now, in order to avoid a conflict between the second and the third pillar, probably in order to complete the process of Europeization of pan-European and cross-border pensions, probably now the European Union should really take into consideration also this project of creating a corresponding pan-European personal product, pension product for companies, and not only for individuals. So to have a PEPP on the one side and the PEOP for companies on the other side. Thank you. I finished.
Speech. I like one of your conclusions that there is potential for both occupational and third pillar, and I don't like your conclusion that there is low level of cross-border occupational pensions because of poor framework, and I believe that the PEPP will now follow this trend. So thank you again. Next, Živka Nikolova from the Bulgarian Academy of Science. There is a speech about the role of the affirmation documents in personal saving products. Živka. Okay, I'll try to contact Živka. Meanwhile, Professor Želazkova will share some thoughts about the ESG factors application in personal saving products. Professor Želazkova.
Thank you very much, Professor Dimitrov. Dear ladies and gentlemen, I would like to share a few considerations that I was having for the last 1-2 years regarding the ESG factors. Apart from my academic career, I'm also the environmental officer of one of the big banks in Bulgaria, and I see that the importance of ESG factors, considerations, and incorporations inside the investment process has growing attention for the last years. And for me personally, it was very interesting to see what your views are with respect to that when it comes to pensions. To what extent investing in green companies, is of interest to pension funds? Because as we know, green companies and green strategies, there are 7 green strategies according to IPAMA and according to EuroSIP classification, and all of these strategies bring substantial turnover, bring substantial profits for the last years. The compound annual growth rate ranging for the different strategies is 5% and beyond, which is far above the deposit rate and also the other bonds or bonds and governmental bonds and others are also much lower in terms of return. So my question to all of you is whether the pension funds, the pension companies are interested in investing in such vehicles through one of the 7 strategies as identified by IPAM and EuroSIP. And also, what is the way to incorporate the ESG factors in the KID, the key information document? Are there any instructions on the market already how this should be done by companies, or there is not enough clarity yet? Thank you very much.
Who will be volunteer to answer these questions? Just to check for Živka Nikolova. Meanwhile, if there are any comments from our panelists, I'm really thank you for all of them. I think very fruitful and productive talk from everyone. Živka, are you ready?
Yes, I'm ready. I have a slight problem with the presentation. Just a second.
Do you need help for the PowerPoint?
Just a second, I'll try. I want to share it with you. No, I can't share my presentation.
Okay, we'll try to help you.
Okay.
It is on the screen.
Yes. Okay. It's okay. Hello to everyone. I'm sorry for this slight impediment. Do you see the presentation now?
Yes, we are seeing.
Okay. Okay. Thank you very much. I'm starting with 2 key information documents, which already have been mentioned by other speakers. These are the PEP key information document and the Pep Benefit Statement as key information tools. After the financial crisis of 2007 and 2008, this is the next slide, please. Special attention has been paid to the development of the European legislative framework for improving retail financial products transparency and mandatory disclosures. Following these trends, the PEP regulation establishes information disclosure as a tool aimed at enhancing consumer decision-making and supporting consumer monitoring. A number of EU legislative acts have addressed this area in the last few years, already mentioned, like the UCITS Directive, MiFID II, and the PRIPS regulation. The report, as I already said, focuses on two information documents, the Pep Key information document as a pre-contractual information document, and the Pep Benefit Statement, which is an information document provided to PEP savers during the accumulation phase. When analyzing the European legal framework, one of the conclusions that can be drawn is that PEP disclosure rules focus to a materially greater extent on format, standardization, and processability, following the same regulatory approach adopted by the UCITS 4th Directive and the PRIPS regulation. Contract law considers, just a second. Contract law considers the next slide. So, as I mentioned, PEP regulation addresses several questions. What type of information to be provided, how to be provided, in what form and by what means and when. So the first information document, the Pep Key information document, is the pre-contractual information tool. That is because contract law considers the pre-contractual stage to be essential, as it defines the terms of the future contractual relationship. Pre-contractual information. Slide 4, please. Pre-contractual information should enable consumers to become familiar with key product features and compare different personal pension products, assess whether the product fits their personal needs and preferences, and make informed decisions. For rules on pre-contractual disclosures, the Pep Kit has been developed using as a starting point the PRIPS kit, but EIOPA has taken into account this explicit retirement objective, which is a specific feature of the PEP as a personal savings product. So the purpose of the Pep Kit is to enable retail investors to compare and choose the most appropriate personal pension product and thus plan their retirement savings. The Pep Kit is built on the same basic principles as PRIPS Kit. It must provide key information. The information must be fair, clear, and not misleading. And as already mentioned, this is a specific expression of the general obligation to act fairly in the customer's best interests. The third is the form. The information must be provided in a form which is understandable and usable by consumers. The document must be short and simple and focused on key messages. And fourth, the information must be provided in a timely fashion. This means at a sufficiently early point in the decision-making process, that is, in good time before PEP savers are bound by any PEP contract or offer relating to that PEP contract. Here, the decision when exactly to provide the kit is left to the discretion of the persons advising on or selling PEPs. They are who shall assess the time needed by the prospective or current PEP saver, taking into account the prerequisites set forth in the regulatory technical standards. And here is the issue of liability, about which Professor Marano spoke, but this is an issue I will speak about a little bit later. There is also such a requirement, slide 5, please. There is also such a requirement to provide the pre-contractual information document to a person interested in saving in voluntary pension funds. So it was interesting for me, and I think to the audience, especially Bulgarians who listen to this report, it was interesting for me to compare the standard template for the Pep Kit and the Bulgarian information document, because a lot of work has been put into the preparation of these standard templates, especially from EIOPA, and consumer testing has been carried out. So it can be said that the Bulgarian legislator can improve the Bulgarian information document, taking into account the standard template offered by EIOPA. When comparing the two documents, one can easily notice that the Bulgarian document lacks key information elements such as there are some key information elements missing, such as there is no clear information on the purpose of the product and target customers, although there is a whole page explaining what insurance in voluntary pension fund is. I think this is not a clear message to ordinary people interested in saving in voluntary pension fund. Second, regarding the risk, there is no distinctive risk description, and the risk indicator which is used is difficult to understand. According to the Bulgarian law, the standard deviation of return for the last 5 years is presented. And this risk indicator is complex. It requires financial literacy and additional information in order to be understood. So in the end, it is difficult to assess the risk profile of the product, the level of risk, and to determine whether the product corresponds to the risk tolerance of the person. Third, regarding past performance, the indicator used is the nominal return on investment, and there is no information on real return on investment. Whereas the real return on investment is the indicator taking into account the rate of inflation. In addition, there is a lack of a relevant benchmark which would enable consumers to compare and assess how the company has performed in the past. And last but not least, the information is presented only for the last 5 years, whereas experts recommend that the provision of information for a period of 10 years would be more appropriate, taking into account the long-term nature of the product. Fourth, the existing rules under the Bulgarian law do not require, please, next slide. The existing rules under the Bulgarian law do not require the presentation of performance scenarios. Of course, the presentation of performance scenarios is a mixed blessing because they can be regarded as a promise by the company for future benefits. They can be considered by ordinary people as a promise by the company for future benefits. That is why if such performance scenarios are included in the Bulgarian information document, they should be accompanied by an appropriate warning that these performance scenarios are estimations and the actual result may differ. And lastly, there is no clear information what happens if the pension company is unable to pay out. So as a conclusion, I may say that having such a pre-contractual information document, the customer will heavily rely, in addition to reading this document, he will have to rely on consultations and advice provided by the pension company employees or intermediaries. And this may lead to a potential conflict of interest for which the company will be liable in the end. So the conclusion is that the existing pre-contractual information document under the Bulgarian law has to be revised in order to include key information on issues, as I mentioned already, and thus improve the quality of the information provided to consumers. The second document, which is in the focus of this report, please, next slide, is the Pep Benefit Statement. It is already known to European customers from the Europe Directive, and it is also a document which we have in Bulgaria, a corresponding information document we also have in Bulgaria. Pep Benefit Statement is an information document which is provided to savers during the term of the contract. The Pep Benefit Statement under the Pep regulation is designed on the same basic principles like the Pep Kit. It contains key information. The difference is that this is key information on a personalized basis. It is short and concise document in a standardized format and comprehensible. It provides PEP savers. It should provide PEP savers with vital information relating their savings and projected benefits. This document would allow members to assess their financial situation and consider if there are any actions they can take during the accumulation phase, such as change in contribution rates, change of investment options, and even switches between providers. As I said, in Bulgaria, we also have such a respective document which provides information to members of voluntary pension funds on ongoing basis during the term of the contract. Can we move to the next slide, please? So again, I made this comparison between the two documents, taking into account the standard template proposed by EIOPA, and it can be easily noticed comparing the two documents that the Bulgarian information documents lack some key information elements. There is no clear information on the total return on investment allocated to the individual account of the pension fund member, although the document provides data on the total value of the pension pot as of a certain date. Second, there is no information on past performance, nor is there a link where a person can get such information. And third, there is no information on pension projections, which, as I already said, if such information is included, then an appropriate warning should be included also that this is not a promise, that these pension projections are not a promise by the company for future benefits. So the Bulgarian information document can be improved in order to provide information to savers in voluntary pension fund with better quality. As a lawyer, I can't pass the issue of liability of persons who prepare these documents, the PEP Benefit Statement and the Pep Kit. Can we move to the next slide, please? Yes. According to Article 31 of the PEP regulation, the PEP provider shall not incur civil liability solely on the basis of the PEP Kit, but he may be liable in the event that the PEP Kit is misleading, inaccurate, or inconsistent with the relevant parts of legally binding pre-contractual and contractual documents. Second, if the PEP Kit does not meet the requirements laid down in Article 28 of the regulation. Here, I mean in particular, if the document does not contain key elements of information specified in the mentioned article. And third, if the PEP Kit and the information is not presented in the PEP Kit in the required form and manner. This also can be a prerequisite for holding the PEP provider liable for the preparation of a PEP Kit. It is important to notice, please, can we see the next slide? It is important to notice that a PEP saver may claim damages from the PEP provider in accordance with national law only if he proves loss resulting from reliance on a PEP Kit, which has these shortcomings, as I mentioned before. And it is on the occasion that the PEP saver has relied on a PEP Kit when concluding a PEP contract for which that PEP Kit was produced. So there are several prerequisites if we want to hold liable the PEP provider. And one of the important prerequisites is that the PEP saver has to prove loss resulting from reliance on a PEP Kit. it is interesting to note that there are no explicit provisions in the PEPP regulation regarding civil liability of PEPP providers in connection with the second important information document, the Pep Benefit Statement. However, in my opinion, this should not preclude the civil liability of the PEPP provider on the grounds of the more general requirement for fair, clear, and not misleading information in the event of providing a PEP benefit statement which does not meet the requirements laid down in the PEP regulation. And in this case, the same principles for holding the PEP provider civilly liable with regards to the Pep Kit should apply. First, the PEP provider shall not incur civil liability solely on the basis of this document. Second, the PEP provider may incur civil liability only if the PEP saver proves loss resulting from reliance on a PEP benefit statement that does not meet the requirements of the regulation when this PEP saver makes decisions concerning his retirement savings. Then the PEP saver may claim damages for that loss in accordance with national law. And the PEP regulation, as already mentioned by people speaking before me, sets forth administrative liability for breach of rules regarding distribution and disclosure. So PEP providers may be held liable, may be held liable for breaking disclosure rules, not only in the field of civil liability, but also administrative sanctions can be imposed on them. And in conclusion, can we move to the last slide? Thank you. A strong competition between PEP and other personal pension products is expected, since these products are offered in the same market and to target customers with a similar profile. So this strong competition in retail financial markets becomes global, with fewer distinctions between investment and savings opportunities. This phenomenon affects not only the perspective of legislators, but also it changes the market behavior of the average consumer in the digital era. So the consumer's need for information and the legal requirements for its provision are increasing. And the market participants that can adapt to and address these trends and this demand will gain a competitive advantage and will get something that is invaluable in long-term commercial relations, that is customer trust and loyalty. Thank you for your attention.
Thank you, Živka. We're happy that among the participants, we have people with law degree. If you noticed, they delivered the longest talks and at the same time productive and fructive talks. So according to the agenda, we are moving to the discussion and questions. I encourage everyone, if there are any questions, to ask now. Now is the moment. Maybe we don't have. Second time, do anyone have questions? If not, we can close today's session and we can prolong tomorrow. Tomorrow we have two sessions which are very interesting, and I encourage everyone to join also. We're starting on the same time. We'll go with keynote speech from Professor Tebaldi from the University of Bocconi in Milano. We have third panel, which is customer in the center of the retail savings and investment products. Also, we have the fourth panel, which will discuss more about the holistic approach about the risk management and the holistic approach in the long-term retail savings and investment products. We have participants from asset management companies, also from universities, from the Bulgarian Association of Insurers, and from the Bulgarian Association of Supplementary Pension Security Companies. So I believe that again tomorrow we will have good discussion. So I'm looking for the chat and I don't see question. I want to close today's session and again to thank to all participants, all panelists for their time and commitment, and we'll have all the presentation on the site, on the website of the VUZF Lab, and send link to all of us. Thank you again.
Thank you very much, and stay safe.